My name is John Sengenberger. I'm Director of Alumni Relations here at the Tepper School of Business at Carnegie Mellon, and we're glad to have so many of our alumni from the Tepper School here for the session this afternoon, as well as other alumni from across the schools at Carnegie Mellon who are here for their reunions, as well as some of our current MBA and MSIA students who are here as well. Today's session is going to be on current trends in financial markets, and we're honored to have Dr. Robert Dammon, Professor of Financial Economics at the Tepper School, to present our panel today and to lead that. Let me say a few words about Dr. Dammon. He has an MBA and a PhD in Financial Economics from the University of Wisconsin-Madison, and his research expertise is in the area of corporate finance, taxes, and securities evaluation. I think they're very happy about you here anyways. He's received a national recognition for a number of his research efforts and his numerous publications in leading journals in finance and economics. He's currently an associate editor of the Financial Management and a past associate editor of Management Science and the Review of Financial Studies. He has taught courses across the campus here to our students, but also has been taught in our customized executive education programs for leading corporations here in the United States and abroad. In fact, he was recently in the United Kingdom, in London, doing a presentation for the leaders of the H.J. Heinz Company over there, and at the same time, our alumni at Deutsche Bank hosted a great reception for us, and he talked to our alumni chapter in London there at that time as well. He has been the recipient of the George Leland Bach Teaching Award for Excellence in the Classroom here at the Tepper School, and before then at GSIA. And he's received it 3 times. He received it from the class of 1987, from the class of 1997, and the class of 2007. So the 7s and Dr. Dammon seem to go well. So I believe you're the only 3-time award recipient here at the Tepper School. So your students have loved Dr. Dammon. And even the year that he took off and went to teach at Duke for a year, he received a teaching award from Duke University, from their students as well in the School of Business. So he's just a great professor, loves his student, is very passionate about his work, and we're delighted to have him here to moderate our panel. So join me in welcoming Dr. Bob Dammon.
Thank you very much. It's a pleasure for me to be here. As you can see, our title today for the panel is Current Trends in Financial Markets, and that title was chosen because it's broad enough that we can basically do whatever we want up here. It doesn't tie us down to anything specific. What I'd like to do first is to introduce our panelists, and then I'll provide a little bit of background as to sort of what's sort of the some important things that are happening in financial markets, and then I'll address our panelists with a question or two, and at the end, in the last 20 minutes, we'll open it up for questions from the audience. We're very pleased and fortunate today to have with us 3 outstanding panelists. You'll see their names listed here on the screen, and let me introduce each of them in turn, starting with Larry Jennings, closest to me. Larry is a senior managing director and co-founder of Touchstone Partners, a private investment firm in Baltimore. He previously served as principal of Carnegie Morgan Partners, a financial advisory firm he founded in 1994. Larry spent over 7 years as an investment banker at Legg Mason Wood Walker. During his tenure at Legg Mason, he rose to the level of managing director and sat on the committee that directed all municipal investment banking activities of the firm. Larry's investment banking experience includes real estate workouts, restructuring distressed municipal credits, sale-leaseback of public real estate assets, and negotiating energy contracts on behalf of public and private entities. In prior years, he worked as a senior financial analyst with Maryland National Bank. Larry's on the board of directors of Boys Hope, Girls Hope of Baltimore, and the Profit Value Funds, a mutual fund. Larry was elected to the Carnegie Mellon Board of Trustees in 2001 and serves on the Advancement and Investment Committees. He has served on the advisory boards for the Tepper School of Business, Mellon College of Science, Mathematical Sciences, College of Humanities and Social Sciences, History, College of Fine Arts, and School of Music. Larry earned a Bachelor's of Science degree in mathematics in 1984 and an MBA degree in 1987 from Carnegie Mellon University. So welcome, Larry. Our next panelist is Pam Zilly, who is a Senior Managing Director in the Restructuring and Reorganization Advisory Group of Blackstone, where she advises companies, equity sponsors, and creditors in restructuring transactions. Since joining Blackstone in 1991, Pam has worked on a variety of assignments that include the restructurings of the Babcock and Wilcox Company, Dow Corning Corporation, Safety Clean, APS Holding Corporation, America West Airlines, Best Products, the Caldor Corporation, Harvard Industries, Lone Star Industries, the Kendall Company, Farmore, Spreckles Industries, and Walter Industries. Before joining Blackstone, Pam worked at Chemical Bank, where she divided her time between the Mergers and Acquisitions Group and the Restructuring and Reorganization Group. Prior to joining Chemical, Pam was a first vice president of the Corporate Finance Department of E.F. Hutton, where she advised corporate clients on common stock offerings, public and private taxable and tax-exempt debt offerings, divestitures, and valuations. Pam graduated from Connecticut College, magna cum laude in Phi Beta Kappa, and received an MSIA from Carnegie Mellon University in 1977. Welcome, Pam. Our last panelist, Jon Kinol, is a Managing Director and Head of Rates Trading in North America for Deutsche Bank. Jon oversees trading of over-the-counter interest rate products, government, agency, and mortgage-backed securities. Jon established the Municipal Derivatives Product Group and Structuring business within rates in 2004. Jon began his professional career at Deutsche Bank as an options trader in 1992. In 1998, he was appointed to head of derivatives trading for North America. Jon received a BS from Duquesne University and an MBA in finance from Carnegie Mellon University in 1992. Jon currently serves as a member of the Business Advisory Committee at Carnegie Mellon University. Welcome, Jon. So we're fortunate enough to have three panelists here that are not only experts but have a wide range of experience, and it'll be very interesting, and I'm looking forward to hearing their views on recent trends in financial markets. Before I address them with any questions, let me just provide just a very brief background of some of what's going on in the financial markets. And I'll address my questions to the panelists related to the issues that I summarize here. I think I would be remiss if I didn't start by talking about the subprime market. We've seen in the subprime mortgage market, we've seen an increase in defaults over the past year. Banks and other financial institutions have responded by tightening lending standards and reducing the availability of credit to subprime borrowers and to some extent also prime borrowers. The housing market continues to look weak. New home construction, existing home sales continue a downward trend. A new round of variable rate subprime mortgages is due to reset next year. So there's also the fear that this is going to trigger yet another round of defaults in the subprime market. This week, I think it was this week, Countrywide Credit announced that they were going to take steps to refinance some of their subprime mortgages early and at lower interest rates to prevent further defaults in its mortgage loan portfolio. The problems in the mortgage market have found their way into the corporate bond markets as well. Investors are demanding higher risk premium on corporate bonds, especially high yield bonds, and more restrictive covenants than in the past. The higher borrowing costs and more restrictive covenants have resulted in a slowdown in the LBO and private equity markets. At the same time, we see oil prices this week have hit an all-time high of over $92 a barrel. Other commodity prices, especially corn, related to ethanol production, continue to rise, and the dollar continues to weaken against other major currencies, down about 15 or 20% in the last 2 years. Despite the recent problems in the housing, credit, commodity, and currency markets, the U.S. economy continues to grow, although at slightly slower rates than in the past. Unemployment and inflation continue to be under control and low, and the U.S. stock market continues to rise, although with greater volatility. It's up about 10%, 9 to 10% on the year, and year over year it's up about 16%. So with that as a sort of a background and a backdrop, I would like to sort of ask the following questions of our panelists. And again, what I'm looking for is just their experience in what they do on an everyday basis, how it's impacted them, and what they see. So my first question for the panelists is, in your opinion, what impact will the subprime mortgage mess have on the overall U.S. and global economies, if any? Do you think this is going to be a short-term or long-term effect? And specifically, what have you seen the impact to be in your own business? Let me start on this end with Larry. Could you respond to that?
Sure. I'm a partner in a private equity firm that invests in sort of small to middle market bank loans and bonds of companies that are in distress or projects that are in distress. And I can tell you that people say, well, what's happening today in the distress market? Well, there's always sectors of distress in the U.S. economy. Starting in, I remember 2001 and 2002, we were buying lots of like hotel bonds. I mean, there were a lot of hotel companies and travel and leisure companies that were experiencing big distress from 9/11. 2002, 2004, 2005, we're buying tons of apartment bonds that are multifamily housing projects in the Southeast because people were taking advantage of low interest rates, moving out of apartments, and they were buying entry-level housing. 2000, about 4 or 5 years ago, I think 8 of the 10 largest nursing home companies in the United States, filed like bankruptcy because of various insurance regulations and everything else. So, from our perspective, there's always like distress in certain segments of the economy. You just kind of have to figure out like where the opportunities are. What I'm seeing is that banks and other financial institutions would like to sell their subprime assets, but they can't get the prices they want for them, so they're just sitting on them. And what you're seeing is that you're seeing institutions that have to generate liquidity, they're selling assets they really you would rather not want to, they're selling the assets they can sell, not the assets they want to sell. So we're seeing pricing of assets, middle market loans and bonds being pressed down because those assets are being forced to sell. The long-term impact that we really see is that people were using their houses kind of like as piggy banks. I mean, as house prices were going up, they were levering their equity and buying flat screens or boats or whatever. So we think the long-term impact is going to be that there's going to be a reduction in general spending, I guess. The other area of concern in the subprime area is that 2 areas of concern. One are these, I think they're called option arms, which are set to reset in 2009 and 10, and those are basically from high quality borrowers that may be experiencing a flattening in their appreciation of their house, and they may actually walk away from those transactions. There's also a lot of sloppy underwriting in the corporate bond area. There was these things, I think they're called covenant light, is that what you guys call them in your business, okay? And effectively they were subprime instruments for like corporate borrowers. So I think that you're going to see, I think people are saying that it's going to be short-lived. I think they're in a denial, and in 2008 and 2009, there will be a mess, basically.
That's good. I think the Blackstone Group is typically, I think, best known for its private equity business. And so since I'm in the restructuring and advisory business, my comments and desires are probably the exact opposite of what my partners would like to see happen with respect to their efforts in private equity. So my comments reflect solely the restructuring side of Blackstone. But I think the subprime mess has actually been very good for my business. We actually represented the two Bear Stearns funds that were, I think, were the first to go. Perhaps not as successfully as we all would have liked, but with respect to the overall impact on our business, I think that I guess I'm not quite as pessimistic as Larry is, although I've been doing restructuring work for 16, 18 years, and I've decided there's no such thing as a long memory. And so therefore, I think the impact is going to be, in fact, very short term. I think that, in fact, you've already seen with respect to both the high yield markets and some of the secured debt markets, interest coming back in, spreads are tightening again somewhat. So I think the concept that people are going to have long memories and the banks and lenders and hedge funds are not going to get into this situation again is just not going to happen. The subprime mess in general, however, I think will have an impact throughout the economy. I agree with that, although people in my side of the business have been hoping for a crash and a fall off the precipice for the last 3 years, and it hasn't happened. You know, everybody's hiring up and staffing up and hoping for a spike in interest rates and, you know, awful things happening such that all of the defaults would rise, and frankly, it hasn't happened. And I'm not sure the subprime area and the situation of the subprime is actually going to push that to happen. I think that you will see, to your point, a decline in consumer spending, although I think the weak dollar may offset that to a certain extent. I think you will see a ripple effect through certain industries with respect to impact from the subprime in terms of, obviously, we're looking at a lot of, you know, home builders, people who supply those homes, you know, the furniture makers, wallboard makers, anything that ripples through the whole housing industry. But as a practical matter, a lot of companies who were in trouble several years ago were able to take advantage of the ability to get very cheap money with very few covenants for reasonable long term. So a lot of those companies are not exactly over-leveraged at this point. And I believe that they may in fact skate through if interest rates stay low and the economy doesn't absolutely head into a recession. So while I'm hoping for much worse things, and I do think there will be opportunities, certainly from an investment standpoint, both with respect to just securities that are already issued, as well as just the purchase of securities and newly distressed companies. At least I don't foresee sort of a massive, you know, reorganization of corporate America here through a distressed restructuring or through Chapter 11 process.
You must not own a house.
It's all people.
I think of the problem in a couple areas. A little about, say, the impact on the economy. Talk about the credit situation. Lastly, kind of what, you know, some thoughts on the market in general. If you look at the economy where it sits today and the impact on the economy is the fact that the economic numbers right now are relatively mixed. You have some weakening in the employment numbers. And the biggest scare that everybody has right now is what's coming up in what's happening in home construction and new home sales. And what you're seeing there is basically just the air getting completely taken out of, especially the construction numbers and the home starts. And also what you're seeing as well is that trend is accelerating and not decelerating. And the fact that from the peak in 2006, that home starts are down somewhere in the neighborhood of the mid 40%, which is a huge number. And on top of that, you look at it and you say what's happened to employment in the construction business is only down about 5%. So it's something has to give there. It's some, you know, these construction companies keeping people on there, waiting for the market to rebound. This is something that'll take a relatively long time to work itself out. So from that aspect of it, you could see higher unemployment rates and more stress on the economy. As far as the unemployment rate is concerned, I mean, our estimate is that if you take that kind of a movement down with the number of people hitting the becoming unemployed, that you'll probably look at the unemployment rate jumping almost 50 basis points from about 4.7 now up to potentially 5.25. So that is the negative strain on the economy that the market or the economy would look to hold up. But against that, which is the negative, against that you look at, say, the global situation is still quite strong. The U.S. is at this time the one that looks like it's one of the weaker areas, as opposed towards a lot of the other economies are actually tightening rates, especially in the emerging markets, especially in some of the oil-producing nations. So what we believe, as I said, that this whole situation will cause GDP next year to decrease by about 1%. Overall, which is obviously not putting us into a recession, but probably moves you back from somewhere in the 3% to somewhere in the 2% area. That's obviously predicated on the fact that things don't become more systemic. When you look at it from the credit side, two things I think are happening. One is the fact that more credit is going to have to move on to bank balance sheets, and the fact that securitizations become much more difficult in this environment. So what you're seeing is a drawdown in ability to finance residential real estate. However, you are seeing growth in C&I loans as well as in credit card debt. So from that aspect, will this have a huge impact on credit formation? I don't think you could make that claim at this stage. I think what you're obviously going to see is the fact that you're going to see much wider spreads pretty much on all credit products. We ended up in a situation that the market probably was overly exuberant, and credit spreads came in everywhere from high yield, whether it was residential or what have you. Now you just see a repricing of all these credits at wider levels. So from that aspect, the credit formation process can continue, obviously, but at higher spreads. And then ultimately, like, so what the views on how that all impacts the market as well is that subprime was the big focus of the market in the summer months. And one of the biggest issues that really has driven, say, the stress in the market is just the uncertainty around where all of the subprime is sitting, and the fact that the market's become very sophisticated. So subprime loans are no longer just simply sitting on an investor's balance sheet somewhere or on a bank. What ends up happening is there's a lot of it sitting off balance sheet in the SIVs, a lot of vehicles funded by CP, CDOs, CDO squares. These are all very complicated instruments that don't have an extremely long shelf life. So what you ended up with was the financial markets that became very stressed because people really didn't know completely what they owned. Even CP, people that are holding CP figured out I have money in a money market fund, this stuff is relatively simple securities, and then they start hearing I actually have subprime, created a lot of fear in the market, which created a lot of people just to disengage, run for shelter till they started figuring out how the world was reacting. And what's happened since that time, I think people are starting to get a better idea of what they own and how these securities will behave. So there is discovery happening. It's not anywhere, I don't think, near complete. But what's happened is that now that the market is moving more towards the economic realizations of where we are. So instead of being in this fear-based, reactionary type of market that we were in the summer, we're now in a much more rational market where you're really looking at the economics. And that's the reason, like I said, you're seeing the market rally now, not because people are just putting money in the treasury bills because they're afraid of being in money market. It's more or less people buying the market now, and the fact that they just think that, as I said before, that the real estate is something that will be a drag on the economy, that the Fed will continue to ease. And from that, people were buying, obviously extending out the curve and buying securities.
Okay, thank you very much. Let me follow up on that just briefly, because there's been some discussion among our faculty, finance faculty here, about the Fed's response to all this and whether it was appropriate or not. There's, I guess, one contingent that views that the Fed cut 50 basis points not long ago, and there's a contingent of faculty that believe that, well, that was a good thing because it kind of prevented this credit market crisis from extending more broadly into the economy at large. Another group thinks that the 50 basis point cut was just sort of a bailout and will do nothing more than encourage those who made bad loans to take higher risks in the future. So let me ask you the question, on what side would you come down on that issue, if you have an opinion? If not, that's fine too. But how do you view the Fed's action? Was it appropriate? Or do you think that they've simply placed in the minds of investors in the market that they're there to bail you out if you make a mistake in the future again? Eric?
Well, I looked at it and I thought that they were rewarding what I characterize as bad behavior. And so I was really not in favor of the lowering of interest rates. I think it just encourages people to believe that they can act irresponsibly and the federal government is just going to bail them out.
I guess I was more agnostic on it. I think they had no choice. Is probably what I thought. I think there was a feeling that, and probably inappropriately so, to your point, there was a feeling that the Fed had to do something, whether or not it was 50 basis points, 25 basis points, whether or not that was rewarding bad behavior or actually was the impetus to calm some of the markets. I think there was a feeling that there had to be something done, and that you know, this was it in terms of making a statement.
Well,
So you
I
can
guess
have,
I'm at a bank, so I'll go the other way.
that was great.
Well, I hear all these comments all the time. I think it's very interesting. I mean, does anybody here Merrill shareholders? How bailed out do you feel? You know, I said, Merrill wrote down $9 billion, and there's probably more coming. I mean, Stan O'Neill, I don't think Stan O'Neill's sitting at home right now saying, geez, I'm glad the Fed bailed me out here. So I don't necessarily see that the Fed bailed anybody out. I mean, the Fed has not, except improved anybody's position in these securities. I think it acted very responsibly in the fact that this became a threat that what was going to be a systemic threat to the liquidity of the markets, and to the potential, the overall liquidity of the system. And even given that you have to look at it from a, there's been so much talk about this since Greenspan, and even his book, and everybody criticizing him. As I said, I think the central bank is supposed to not have the economy completely melt down when it can, look to not go in that direction. So I think they're acting responsibly. It was more, like I said, they didn't bail anybody out. It was more providing liquidity to the market. And then at the same time, as you looked at Northern Rock, and the Bank of England was even much more adamant that they weren't going to do anything for anybody. It's like everybody's on their own, and we're not going to do anything. But then when Northern Rock ran into problems, people were actually lining outside the door to get their money. Now they're starting to worry about runs on the financial system. It made a lot of sense to turn around and say, you know what, we will make people whole. Because ultimately, like I said, this was a very interesting problem in the fact that banks, for instance, were having a lot of problems financing or rolling paper over for 3 months' time. So the whole financing market, which is generally termed out anywhere from overnight to say 180 days, every time something was rolling over, it would just go into overnight. So it becomes a very dangerous situation for the whole economic system to be rolling over to that, such a short term. But then you looked at it, at the same time, banks were issuing 30-year debt at unbelievable amounts, and there was just huge pent-up demand. I mean, even like I said, Deutsche Bank and other banks, you could have issued as much as you want. There was such a pent-up demand from real money accounts, pension funds, what have you, to buy bank debt. So it was very odd in the fact that people were running to buy as much as they can of 30-year debt, but I really don't trust them for the next 30 days. So from that aspect, I said, you have to look at it. It's clearly a liquidity issue. It's not a bailing out investors or anything along those lines.
I mean, maybe the more interesting question wasn't so much what the Fed did was correct or not, but what did the Fed do or not do that led to this whole quote, bubble or whatever you want to call it.
Well, I guess there is the criticism of Greenspan for keeping rates as low as he did for so long, that encouraged the borrowing that Larry spoke to earlier. So that's right, yeah. Okay, let me shift, if I can, from credit markets to sort of equity markets, and ask, I talked about a lot of different types of risks in my opening background statement. We had obviously the risks of the credit market, but we also have the commodity prices, oil prices in particular. My question is, but the stock market seems, even though it has higher volatility, seems to be holding up fairly well. My question to you is, are these risks that we see today, do you think they're fully incorporated into the risk premium in the market now? Or do equity investors, are they looking at best case scenario in terms of what we're looking at in terms of today's prices? I'm not asking you for a prediction as to where we go from here. I'm just sort of asking, are the risks that we saw in the credit market, which now seem to have been fully captured in prices, do we see that now in equity markets? Larry?
Well, I should mention, Pam and I were just laughing. See, most of the companies I invest in, in their projects, they don't have any equity. I mean, they don't have so I think that's kind of interesting, and kind of as a personal kind of investing, I'm very hard asset oriented, so I really don't follow the equity markets much. But the other day when I was, I have kind of a fuel efficient car, and I happened to borrow my wife's SUV, and I filled up the car, and I was like, wow, I mean, it was kind of shocking, and I thought about a family that had to fill up an SUV, a couple of them, once or twice a week, and I multiplied it by 52, and I said, this could take a real bite out of your typical American family in terms of their spending. So I think that I am really concerned about the $92 per barrel oil price, because I think it's got to translate into less money for American families. I'm really concerned about it.
Yeah, I mean, the equity markets is not where I spend a lot of time, mostly as Larry and I were laughing. It's not only so much that the companies that we advise, it's probably one of two situations. Either they are, even though the company has announced, and this is a general statement having nothing to do with any of my existing clients, I'll say that for the record, that even though the company may have announced that there's, they're in a restructuring, there's not going to be any equity value remaining for the existing equity, that the debt will in fact, wipe out any equity based on the overall value of the company. Those stocks continue to trade at sometimes significant premium. So I'll be the first to admit I don't understand the equity markets at all, but with respect to the current market, I mean, it is interesting, and I think it does all. I think it's a very large circle in terms of starting perhaps with the subprime situation in the summer, moving on to sort of the lack of liquidity. Whether or not the banks are going to have to take more write-downs, whether or not they're going to have to start adjusting their exposures and starting writing down their assets more towards the end of the year, so you're going to have capacity and capital constraints, whether or not that forgetting sort of the pricing and whether or not they're going to be able to offload some of these loans into other investors, and how that potentially could lead to more and more defaults. And so it does sort of become a very circular equation, and we as a group keep sort of a running tally on companies that are single B and lower, or double B and lower, or have more than 5 times debt to EBITDA coverages, and this is probably a too general a statement, but for the most part, when you're saying, oh great, perfect opportunity, $800 million of debt, single B, going on the downside, 7 times leverage. Public company, you look at their stock price and they're, and they're trading, like a normal company. So, I haven't figured out yet the connection between credit markets and equity markets, to be perfectly honest. But I guess that means that I think there is, speculative part of the equity market going on right now, and has been for some time.
I guess the way I think about it, because I'm not an equity person, but I guess being fixed income, but. The one thing that we see on the fixed income side very strongly is the fact that the amount of money that's just out there looking for a home is just enormous. And then you really have to, everything that's going on in the world, I think you always have to just think back and say there's this big, there's this big trend in the market, and has that trend really changed? And the really underlying trend of the last, say over the last 5 to 10 years is the world becoming more capitalistic, right? You have these huge economies in Asia that are coming online and producing tremendous amounts of products and what have you, generating revenues, very limited investment opportunities in their home market, so they want to put that money back in, so the natural place to put it is back, a lot of it comes back into the U.S. market. I think traditionally a lot of that went back into the fixed income markets. And that's still, for all intent and purposes, appears like that's still in place. Now, that can change very quickly, but if you look today, that's still there. So a lot of that money has to end up in a home. And if you look what's even happened at the central banks are moving more and more money out of fixed income and into equities, even making investments in
Private equity.
Private equity firms. So, so I think that's a very interesting aspect, that they're going to go more into equities. So that's one aspect, I think, that supports equity prices. And I think that will continue. And then I think the other issue that you have is just when you look at just what's happened with this big chunk of money that's just flowing through the system, it's creating bubbles wherever it goes to a large extent. But ultimately, even though it creates bubbles, it hasn't created any complete disaster for economies. And the fact that you had an equity bubble at the turn of the century and of the millennium, and then you had when all that money went away, I think I lost all this money in equity. You can't trust CEOs and all this, so I'm gonna put my money in my house. I know there's no SPVs or what have you, so they put their money into real estate, and now real estate looks like it's coming down. And now I think people just come back in and say, you know what, just buying a company, Exxon or any company that manufactures something, might actually be simpler than some of these financial instruments that people are talking about now, and CDO squares or what have you. So I think as long as there's that pent up amount of money looking for a home, I think equities could do reasonably well.
Let me follow up on that. So we see investors chase return all the time, and they move from one sector to another. And one could argue that there's a lot of money chasing or being invested in private equity right now. So maybe I'll address this to Pam. Is there a bubble in private equity? Is there too much money flowing to private equity now? No.
It's never enough money. I guess what is, quote, too much money? I mean, is it driving up values to what? I mean, what's too much? I guess how low is low and how high is high, and I guess how high is when you don't want to pay that much, as an investor. But I mean, I will say that from Blackstone's perspective, anyway, I mean, our view is that values certainly over the last couple of years for companies that we were looking at to make a private equity investment in, that we probably lost more than we won with respect to those that we had worked on and bid on, precisely because we were getting outbid. At reasonable and I'm not talking $1 higher, 10% premiums to what we thought was the right price. So is that an indication that there's simply too much money investing, looking for a home in these deals? I don't know. I'm not sure that. I think that's somewhat of a, certainly that's an impact. That has an impact. Obviously, more money drives up prices, but when is it too much? And just because it looks like too much to somebody, it may look like a great value to somebody else, and that's obviously what makes a market. But but no, we like money in private equity business.
The reason I ask is that there is some academic evidence that the number of private equity firms increases substantially during periods like this, and that the returns to the limited partners in these private equity firms don't always meet their expectations.
Mm-hmm.
And that the good returns tend to be concentrated in very few large private equity firms. I would imagine Blackstone is one of those. But if you look cross-sectionally across the private equity, the returns aren't really all that great.
Well, I think it's not just private equity firms. I think it's hedge funds. It's wherever there's a lot of money looking for a home to make a greater than average return, and by definition, you're not always, they're going to either make too big a bet on the wrong thing or just have subpar returns overall.
Okay, I want to give time to the audience. I want to ask one last question, and sort of an open-ended question, which is, thinking about what you do on a daily basis in your business, what do you see as the most important trends, since this is trends in financial markets, the most important trends taking place right now that are going to have the biggest impact or the biggest influence on your business or on the economy at large? And again, let me start with Larry up there.
Okay. There are probably 3 areas that I think about, probably the most. One is probably just kind of people and population, and the fact that I think one of our biggest long-term issues is like undisciplined kids. And I say that in that because these undisciplined kids show up at companies,
That's a trend in
and you almost have to retrain them in manners and just kind of behavior and work ethic. And so I would say that's one of my big concerns is undisciplined kids that translate into undisciplined young adults that end up making lots of bad decisions. The second thing is I think that the U.S. needs to figure out its policy or think about immigration, because I think we have an aging U.S. Population, and we're talking about shutting down our borders to the workers, and I'm not sure that that's the right strategy. I think we have to take a more balanced approach and say, okay, if we're going to have a huge aging population, who's going to do the work in the country? And the other issue is probably water, I guess. And you think about sort of the most basic resource and what's our long-term strategy for dealing with water issues in the U.S. And those aren't really things that affect my business directly, but those are the things that I think about a lot.
You really think more than I do. Yeah, but you're thinking the right stuff, big picture stuff, and I'm thinking probably more real day to day in terms of dealing with clients. And I guess not in any particular order of importance, and these aren't exactly new ideas, but I think that in terms of what's going on in the financial markets and how they affect my clients, and frankly, as I said, most of my clients are distressed companies, obviously, although some are actually very good companies that have just the short-term problem. But I think the fact that the world is now a global business, I don't think a lot of companies have figured that out yet. And particularly with respect to some of the things we're going to talk about earlier in terms of currency hedging. What does that mean? Where do I place my factories? Where are my customers? How do I deal with that? And I think a lot of companies simply have not focused on the fact that this is a global economy these days, and that regardless of whether you're selling widgets in Western Pennsylvania, that your market still gets affected by that. And how do you deal with that from a management perspective? And I think, strictly in financial markets, I think it's 2 things. I think it's just the volatility in the markets these days. I mean, maybe I'm just too old, but way back when, the 20th anniversary of the 1987 crash obviously just happened, and I was reading in the paper all about, oh my God, and everybody was writing articles about what it was like, and I'm sitting there going, I know it was like I was there, And so, I worked at the and the stock went down to a nickel, and I was out of a job the next day. So yeah, but people are saying, well, it couldn't necessarily happen again because of this and diversity of risk and not concentration of assets and all that. Maybe yes, maybe no, but by the same token, I think there was just a lot more volatility, and I think a lot of it's driven by, as Jon was saying, that there's just a lot of money flowing through markets these days, which cause very large market moves one way or the other. And I think it's this whole trend in the creativity of the types of securities that are being issued in the market. I mean, nobody just sells stocks and bonds anymore. We've got a lot of creative minds out there, a lot of them probably generated from this school, who have come up with ways to sell things that, at the end of the day, nobody potentially quite knows, what they're buying. So I think that is just a trend that's going to continue. I don't see it going the other way, but I think that adds to the potential volatility in the markets, which does affect companies when they're in the capital markets.
The 2 things that kind of strike me as one is the regulatory environment in the U.S. It just seems that compared to looking how businesses operate in Europe and Asia, is that now we've become the we've become one of the worst areas to do business in the fact of just, the amount of, like, say, the whole Sarbanes-Oxley and so many more regulations and procedures or what have you. And it does inhibit, I think, risk-taking across, many levels of the institution. And then probably most important is just the fear of protectionism and the fact that, if the U.S. is one of the, is slowing down when the rest of the world is speeding up, does the U.S. turn around and actually we have a election coming up soon, and there'll be a lot of talk about protectionism and who plays that card. But I think that's something that's probably most dangerous to the growth that we've seen over the last 10 years or so, because I think, like I said, from what we talked, the flows of funds in the world, that's one of the big drivers of the of the economy for the U.S. and globally for the last 10 years or so.
Okay, thank you very much. Let me open up to questions from the audience. There in the middle, yes.
Following up on your comment with regard to regulatory, on the equity side, you did have you have to law went on WorldCom, you had the implementation of SOX, and now with you've got on the debt side, you've got these derivatives, and you've got a lot of these different instruments that really aren't transparent, and the pressure to put on the rating agencies. What do you think the impact of that's going to be? I know you've got stress tests that are looking at, but in terms of putting transparencies on what they really have on their balance sheets.
Well, I think the issue with the rating agencies was a scary situation. The fact that people bought a lot of securities because they're AAA, and a lot of especially the non-U.S. investors, they just assume, hey, it's AAA Standard & Poor's, it's fine, I can buy that. When the underlying economics of those securities are obviously they don't understand it completely. So I think, like anything, these situations lead to, investors going forward are going to go back to what they always should have been doing, is doing their homework and saying, okay, what exactly is it to what I own? I can't just necessarily buy it.
But they don't know what they got themselves. So your comment was, Pam's comment was, they don't even know what they've got on their books.
Well, that's the whole issue, like I said, in the price discovery, and the reason, like I said, what's going to happen here it won't be something that plays itself out in 30, 60 days, because it'll take some amount of time to play through to what those securities are. Now, I'm sure there will be some regulations around how the rating agencies look at the world. But then again, the rating agencies look at the world, it doesn't seem reasonable if it's a AAA security, it can go from AAA to like just zero overnight, right? So there's obviously a flaw in the model. Which is something that needs to be addressed, but ultimately, the way that the rating agencies look at the world is just very different than the way a lot of other investors do. And the fact that the rating agencies just say, statistically, historically, we have these type of scenarios, so therefore it's AAA, whereas if you're a trader in the market and you're mark to market, you just know, okay, that's fine, but if everybody sells it, I'm going to take a lot of losses, and there's only so many losses I can take before I get fired, right? And that's something that I think investors needed to, be more aware of as well.
I can see political pressure put on them to go ahead and change their.
Well, I think I said the political pressure will be heavy. The only problem is, like I said, you get up in so much more regulations and what have you, and we kind of just start, like I said, my view on Sarbanes-Oxley is like all the things that happened in 2000 were illegal, right? You didn't need to have like a new thing to say, hey, that's illegal again. Right, so they could just went after all of the CEOs that were doing illegal, whatever they were doing was illegal. So now we have like this new name about doing illegal things with a whole set of procedures that's very costly. So yeah, I think that there should be some, there should be something along the rating agencies. And I think the rating agencies are going to take obviously a lot of heat over this. But ultimately, do we need like another stack of papers about what the rating agencies mean? So ultimately, what ends up happening when that happens? The regulations that the government will put on that, I don't think will be all that applicable anyway, because most investors now, they're institutional investors, say this is AAA, so okay, that's great. I'm not going to buy it until I understand it, which is very different than how they acted in the past. And I don't think you need regulatory activity to get you there.
Plus the other problem, I think, is with respect to the values of these securities. I mean, the rating agencies, I think, were trying to look at the underlying values, which in fact may still be there. It's the fact that the market, no one's prepared to, so how do you value value? Is value hard value, or is value what somebody's prepared to pay for you for it? And right now, no one's prepared to pay very much for it. So that's going to be hard for any rating agency to figure out, I think.
And with respect to regulation, clearly this has the biggest impact on small firms. There's huge economies of scale associated with dealing with regulation. So small firms are impacted much more heavily than large firms are. And you're also seeing foreign firms delisting from the U.S. market and not listing here as a result of these regulations. Yes, question?
Yes, I'm touching off of what he said. I just read recently in the Wall Street Journal article about how some of the mortgage-backed securities and complex asset-backed securities are not marked to market properly by banks. And actually, they may not even know the prices of these securities at certain point in time, or what they call marks. And therefore, the amount that they carry on their books is not reflective of the true worth of these securities. And that kind of puts these banks in a quandary and probably even leads to misreporting of these securities to the investors and people who think, banks will pretty hefty balance sheet.
Okay, this is where I think that that's sort of like the sort of that's where rubber's going to hit cement, I think, at the end of the year in the first quarter. For example, we were sent a big Excel file of about $120 million of subprime mortgages, and someone asked us to make an offer on these mortgages. So let's say it was roughly 1,000 residential mortgages. So we said, okay, we're going to take 6 or 7 people. We're going to analyze each residential asset, because there are like 3 or 4 databases you can go to and figure this out. So the seller said, that was a Monday morning about 10 o'clock. The seller said that we want pricing back 9 a.m. on Wednesday morning. So we did some simple calculations of how much time you can, let's say 500 man hours to analyze these 1,000 mortgages. And we told them that we were not going to give them a price because there was insufficient time to analyze these 1,000 mortgages. So we took 100 of them, we assigned some people to them, and we came to a price of about 73 cents. That 2 days later, the seller or the seller's intermediary told us that those mortgages had traded for 92.7 cents. So, all right, which tells you that someone did not do their homework. I mean, we took a good cross-sample these mortgages, and we were valuing them, 25% less than what they traded for. So I think you're going to, and this happened about 3 or 4 months ago. So someone thought they were getting a good price at a 7 cents discount from the face value, and realistically they should have been marked down, 27 cents. So that's where I think the real issue is that people are really in denial, and these securities and assets are probably worth a lot less than they're reporting. So I think that's a big issue.
So can we go to the market today and try to buy these securities at a fair price?
A lot of these securities are not trading. I mean, a lot of the really depressed credit instruments aren't trading at all. So what's the price if they're not trading?
Or even if they were.
Right.
Other questions out there? Yes.
I have a kind of a double question.
I'll allow that.
You'll allow that? We heard from the panel that they thought that the economy could slow down. So I wouldn't disagree with that. I think you said from 3 to 2%, which is a big slowdown. Question number 1. What is the likely impact on corporate earnings of that slowdown? Second question. If that slowdown takes place, I assume the U.S. will, the Fed will lower rates again. Now, we talk, not being American, we notice the dollar not very strong from where we sit. And if the Fed lowers again interest rates, what will become to the foreign appetite for U.S. assets? And if that appetite decreases, what's the likely required future interest rate?
Anyone want to answer that?
Is Alec Greenspan here? Great.
Well, interesting enough, you know, I would say that foreign investors have moved up the food chain a little bit. You know, they used to buy mostly Treasury securities, U.S. Treasury securities. Now you see them as active investors in all asset sectors. They go and buy companies. They're buying real estate. I mean, so I'm not sure it's as simple of an answer as it was, say, like, you know, if foreign investors pulled back from U.S. investments in, say, 1977, they're buying less Treasury securities. So the question is, does that mean that they're going to buy less Treasury securities because yields are low? Yeah, probably. But if they think the other assets are cheap or inexpensive, they'll buy hard assets basically. So it's you know, I'm not sure.
I agree with Larry.
Yeah.
No, it's, you know, I was laughing. One of the questions that was potentially going to be discussed today was, you know, currency rates and currency movements, and we all sat up here and said, well, we don't know anything about that. So you obviously didn't get that memo that, you know, we don't know anything about currencies. But I think that, look, you know, if we all knew the answer to that, we all wouldn't be sitting here. But, you know, and you sort of forget the other overriding part. You know, it's the trade-off between, you know, a slowing U.S. economy, inflation, which is that driven by commodity prices, and are commodity prices really driven by demand these days, or is it driven by, you know, trading in commodities, and employment rates? But, you know, frankly, at the end of the day, it's all going to come down to politics, in my view. So I think that I think, you know, now, you know, if the Republicans had a prayer of winning, which they probably don't, unfortunately, you'd see a very different economic policy, I think, being put into place than you might see otherwise.
Well, I think so. We were saying you're asking if more or less just on the FX rate with depreciation of the dollar, the impact on foreign investments. I think that part of it is, you know, I think that obviously it makes U.S. investments less attractive. However, you still look at it, and people have to invest in, to a large extent, what is ultimately manufactured from an investment standpoint. So what ends up happening is that there's so much money being generated, and the U.S., a lot of that investment still ends up in the U.S. for a couple of reasons. One is the fact, like I said, it's very large and liquid. So even if you want to diversify, there's not a lot of areas to diversify away from. You know, the yen market is even worse. You know, the euro market, a lot of European markets aren't deep enough. Asia, you know, Asian markets, I think what's going to end up happening is that a lot of the Asian economies, as they become more and more developed, they're going to want to develop their own infrastructure internally. So a lot of that, instead of just taking that money and processing and moving it back overseas, they're going to start moving that more internally. Does that mean that they liquidate, you know, U.S. dollar denominated investments? No. Does it mean that the trajectory is slower? Yes. That's the reason I do believe that that the dollar probably depreciates more in the fact of, like I said, oil prices. Given the price of oil right now, we estimate you need to sell about $2 to $3 billion worth of dollars every day. That's from the oil-producing nations. You have that issue. You have, you know, diversifications away from fixed income, U.S. dollars, and what have you. So we think obviously that has a steepening effect on the curve. So you'll have a steepening effect on the curve and probably a weaker dollar until, you know, something happens. If there's stress in the world, then you'll see a very strong dollar again, because no matter what the yields are, people are going to feel more comfortable in a very deep, liquid currency, as well as, you know, currency that you know, people have a lot of history with.
Okay. The other thing I'll say is large corporations these days have international operations, obviously, and so they're much more tied to global economies than they are to any single country economy. Lower interest rates in the U.S., and people are talking about the Fed maybe cutting another 50 basis points possibly. Some of them may already be factored into the current value of the dollar already. But a declining dollar is going to be good news for exporters of large U.S. corporations exporting to other countries. And so the impact on corporate earnings, I'm not so sure is going to be all that significant. There is that sort of other effect going on. Question?
I was going to ask this question before. before Pam, make the political remark, which I think may be important. The Republicans have succeeded in transferring a great deal of wealth to the richest Americans and adding trillions of dollars to the national debt. I don't know whether the debt ratio of debt to GDP person. But I think if the Democrats are elected, particularly President and Senate and House, there may be a significant change in the tax structure to eliminate the federal deficit. I don't know whether this comes in the context of current trends in financial markets, but if you look at that scenario, you see any significant impacts on the financial markets.
Well, if history is any indication, the stock market will go down and interest rates will go up. So when the Democrats are in control, but I think my comment related more to if in fact the Republicans were looking to stay in power, then that might affect not that we control much. I'm a Republican, control much of anything at the moment, but with respect to the age-old adage that no one likes to raise interest rates, in the year of an election. But again, I think that's simplistic and an analogy in the face of the complexity of markets and what's going on today. But I do think interest rates would go up under a Democratic administration, a Democratic-controlled House. I don't think that's any surprise to anybody. And whether or not the overall impact, when you take into account what that does to the dollar versus inflation versus company earnings, it's going to be good or bad. I for one can't foresee that quite at the moment, but I think it will be it may not be a trend, but it's going to be a change. Certainly, I think with respect to the trend in interest rates in the past.
Interesting you should bring that up on my 5-hour wait in Newark Airport while it was raining last night. I actually Greenspan's book, and I was actually on the chapter where he's actually calling to task the Republicans for that same reason. It's the fact that they said when they came in, they said the Republicans didn't act all that Republicans and the Democrats didn't act all that like the Democrats. So obviously I think what's happening is that the political parties, it's really hard to say the Democrats are going to get in there and spend all the money when they basically, Clinton balanced the budget, and then the Republicans got in and he spent it all, and they leave a deficit. And, so I don't necessarily know if it's as party-centric as it was in the past, but I think that's an issue that will probably become a political debate. But you are in a situation now that's probably more healthy for the overall economy. And it looks like even now you have seen some reduction in the deficit because you had a very strong economy. You had a lot of tax receipts that were not built into the original budgets. But it looks like from where we currently are, the tax receipts and the budget deficits going forward. I think we're talking, I think, 180 billion. I think they're talking next year to be at like 240 billion. So you're definitely, given the current structure, you're heading towards higher deficits, so something probably would have to be done politically within the next year.
Yes.
You guys are seasoned and been through a couple, quote unquote, either difficult periods or scandals or whatever. If you will take the time to compare long-term capital to what you're seeing now, just think about it. What's the difference?
Well, I think one of the differences is that similar and different, I guess. The long-term capital was like levered, like, I don't know, like, I think in the final analysis, it was like 500 to 1 in terms of the assets that they had as equity. And I think if you were to look at the sort of real bad guy in most train wrecks, it's generally too much leverage. Everything else can sort of get solved. Things, for example, if you owned an asset and it was levered 9 to 1, and if it just goes down 10%, you lose all your equity. Okay, so I think the similarities are long-term capital was just a super levered entity it has a problem. So I think that there's some similarities and different, you know, the Bear Stearns funds that lost all their money, right? Were you involved in that?
Not personally.
Sort of, but I think those funds were highly levered as well. So fundamentally, things go down a little bit in value, we lose a little value, that's not a problem. The problem becomes when you have a lot of debt on an investment and it goes down in value and you get wiped out. And I think that's where you're going to have the problems. And quite frankly, banks are highly levered. I mean, banks don't want to talk about this, but look at a typical bank balance sheet. It may be, let's say, you know, 10 billion of equity and you know, 100 billion of assets. So let's just think about if some of those assets are impaired. Let's say, you know, start to write down a lot of assets, and these banks are highly levered. You know, that's going to be the problem.
Or if what's off the books is put back on.
That's right.
And that's what's going on right now. And the basis is there's no definition. Long-term capital, who's defined? Who was? You're even through.
Yes, I was going to say the same. I think the biggest difference is that the LTCM was a contained issue. You turn around and say, okay, I know what your securities are. I know exactly how they'll impact everybody. It's a closed form problem, whereas the current situation is much more open, and credit and permeates everything that we do. So it's definitely a much more complicated issue. But the area that's similar is that at the end of the day, if you look back at LTCM, if LTCM blew up like that today, nobody would even care.
I was just going to say, that's, to me, that was going to be the biggest difference, which was, you know, for whatever reason and whether or not markets understand it correctly or overreacted back then. But
markets
today,
were scared back then because
right.
they said, we've never seen this. We don't know what a hedge fund is. What is this thing? It blew up, right. And I think it's supposed to take the whole world down. Everybody got nervous. Right, but then after it happened once, like it's just like another leveraged investment, like any other levered investment, and Amherst goes down and didn't even create a ripple. And as a matter of fact, all the other hedge funds are really happy because they can buy cheap assets now.
Okay. First of all, I want to thank all of the panelists for being on the panel. I'm going to ask them one last thing, if they would, in the sort of spirit of Alumni Weekend, to sort of maybe spend just a minute telling us how their Carnegie Mellon education and experience has helped them or hurt them in their careers. Larry, can I start with you?
Well, I think it probably gave me a chip on the shoulder. 1987, I'll never forget, I finished business school. It was May of '87. Go to work for Legg Mason, which was an emerging money management business back then. And the first day, this kid walks up to me. He's about a couple years older, and it's his first day. And he said, "I'm from Harvard, and I understand that you were you kind of were one of the last hires in the group, and whatever." So after working about maybe the second week of working on a finance issue we had at Legg Mason, I looked him in the face and I said, in probably about 3 years, you'll be working for me. And he said, why? I said, because you don't know anything about finance at all. And 3 or 4 years later, he was working for me and he left the company. So I think that, back then, we were sort of like kind of like the underdogs, I guess. And I think it gave me a little extra edge to work really hard. And also I realized that fundamentally what we were being taught was really critical. And a lot of this soft, fuzzy stuff is kind of important. But if you're in a finance business, you're dealing with like fixed income instruments, you better know your math. I mean, that's what it's all about. And I would say the Carnegie Mellon education separated me from the people who kind of had like softer MBAs, basically. So.
No, I think it's similar to my experience. I came here directly out of undergraduate school and had no work experience, and the more I sit here and listen. I think I probably would have done much better if I'd actually had some work experience, but I might have actually known what depreciation was if I had worked for a couple of years before going to business school. But I came out of an undergraduate school with a liberal arts education and then came directly here, and you know, a typical 21-year-old had no idea what I was going to do with my life. Or where I wanted to work or what I wanted to do, but ended up going directly to Wall Street. But clearly I would not have gotten the job on Wall Street if I had not gone to Carnegie Mellon and actually managed to, you know, learn something while I was here. And in fact, when I remember being interviewed, one of the guys said, you know, I don't, you know, we haven't spent much time talking, and I don't really have a whole lot of time to assess whether or not you'd be good, bad, or indifferent, but all I can tell you is anybody who goes to Connecticut College undergraduate and Carnegie Mellon graduate school has got to be smart, so, you know, we'll hire you. Right. I said, well, you know, you didn't notice any magna cum laude next to Carnegie Mellon degree, did you? That was just the undergraduate degree. But in all seriousness, I mean, you know, I picked a finance career, or it picked me, I guess, but having been in it now for 8, 9 years or whatever, there's no question but what the approach to that this business school uses to its education serves one incredibly well in the finance area, and it's not just, you know, it's not accounting, it's just not being able to look at numbers and understand numbers and appreciation and balance sheets or trends in financial markets. It's the whole approach to when you're dealing with a company that you need to understand, everything can be reduced in some fashion to a number or to a quantitative analysis. And look, I'm a liberal arts undergraduate major, so I'm big on the whole qualitative side as well, and the soft stuff, and you play to your strengths, so I was good at that. But at the end of the day, it was not just, you know, one class or one professor or one this, it was the whole approach that imbues this education, which is, you know, you have to think from the CEO's perspective, or from the market's perspective, or from an investor's perspective, you know, from a financial and analytical standpoint. And it teaches you that, and then it also teaches you the skills to be able to do that and the tools to be able to do that. And to me, you know, it's as I said, you know, I wouldn't be sitting here. I don't know where I'd be, but I wouldn't be sitting here, I know that.
I guess probably the thing I remember is that they just throw so much work at you. It's like there's no way you can actually, because from my undergraduate days, you can actually read everything and really know before you go to test. I just did, I'm pretty well prepared. We're here. I just never felt I was completely prepared, because they throw all this stuff at you. Just like, well, absorb as much as you can and, you know, deal with it. So you kind of, which I think helps to say when you're in the real world, you never have all the information. So you have to take as much information as you can get, and then, you know, make decisions with it, and then work with it from there.
Okay, thank you very much. Larry, Pam, John, thank you very much. You've been great.